Eric, and good morning, everyone. Welcome to January, another conference. I'm very excited to be here, partly because, or largely because, I feel right now more confident in this space than I have for a long time. So that is, I mean, I always get the privilege of starting off the conference, which is great because it makes it easy for me to know what to talk about. I'm the first person up here, so I get to talk about everything. No one's covered any ground yet. And so everything for me means, why am I sitting here saying that this is the best outlook that I've had in years? Well, if we're going to look forward, we certainly have to start by looking backwards. So let's look at 2017. The metal space was good in 2017. The metal prices themselves did fairly well. Gold gave 12%, silver not so much, the miners not so much. Those lags in silver and in the equities, I think, come down to one word, which is that investing in mining equities just to many investors felt unnecessary last year, right? We had the S&P still just killing it. We had lots of high risk, high return opportunities in cryptocurrencies and in marijuana stocks and in all kinds of unicorns. So it was just a bit unnecessary to come into our space. Base metals did better. Certainly the gains in the metal prices were phenomenal. I mean, we have zinc up 120% in 2 years. That's a stellar performance. And we've had good leverage in the producers from those of those base metals. But on the exploration and development side, I would say the leverage has still somewhat been lacking. There's been more of a range. There's certainly been some standout performances from explorers and developers in the base metal space, but it has still been lacking. Again, I just think that investors haven't felt the need to turn over to our space. And yet I started this talk by saying I have the best outlook right now that I've had in ages. So what has changed? What's different today? What I've come to think is that last year was the year that everybody sort of got comfortable with things being what they are. The market was able to get as comfortable as it is with Donald Trump, was able to wrap its head around some economic growth numbers that look more stable and reliable than they have in a long time. It was the year that growth stabilized. It was also the year that, boosted by cryptocurrencies and pot and some of these unicorn tech stocks, stocks really have started to look very expensive. Now, we've been saying that for a little while, so that's just something we're going to keep saying. But they really are starting to look very expensive, and conversations about bubbles or euphoria stages of the market are becoming a lot more widespread. So that's where we were. Now, 2018, I think, is the year where growth is going to start having its spillover effects. And those spillover effects are all bullish for commodities. We're talking about wage inflation that leads to inflation. We're talking about competition among currencies because growth is more widespread globally. The US dollar is not the only game in town. We're talking about commodity demand starting to outstrip supply across the board. These are all things that happen later in a business cycle. We needed to develop confidence in that business cycle first, and that is here. And so now we're going to get into some of those late stage manifestations of the cycle. Add in the fact that we have this bull market in stocks that's very long in the tooth, very expensive. And what I've come to decide is that this is the year that we're going to see generalist investors start rotating into commodities for profit and for diversification. I'm not the only person who thinks this, which is why I have a little bit of confidence in thinking it. Some of the things listed at the bottom there, Goldman Sachs has been very clear that they're recommending investors overweight commodities because of their rare offer of value. One of these Bloomberg intelligence strategists has gone so far as to say that the technical setup for the metal space right now is similar to the beginning of the last bull run. And the most outspoken and influential such investor of late has been Jeff Gundlach of Double Line Capital, who's using this chart effectively to argue about the relative valuation offered by commodities today. So this is the commodities index in a ratio to the S&P 500, and it's like nowhere, right? It's about as low as it's ever been. And his comment is, commodities will outperform in 2018 because they always rally sharply late in the business cycle. This is exactly the story that I've been telling as well. Okay, so let's talk a little bit about that business cycle. Let's gain some of the confidence that I am suggesting exists in the fact that this business cycle is doing what it's doing. There's lots of data out there. People can argue growth and have been arguing growth both ways since it started. And I've been on both sides of that argument, so I'm happy to say that. But at the end of the day, it is manifesting. It's been slow as all get out. It's been like the slowest expansion ever, which is why there's been such a lack of confidence in it for so long. But there is, I watch the data, increasingly the data is saying growth is happening, and really importantly, it's not only happening in the United States anymore. We're now getting fair, reliable, solid growth numbers out of the Eurozone, out of Japan, right? These things really matter. When you have broad growth, then the demand for commodities and all the manifestations of that growth are far more significant than if it's only happening in America. We do have, China just reported its 2017 GDP growth rate, 6.8%. I mean, for whatever that's worth, right? This is China reporting its own numbers, but that's still a very strong number given how manifestly immense the Chinese economy is, right? So growth is happening. Commodities perform late in a business cycle. This is already starting to happen. This is that same index, but not in a ratio, just the commodities index. It's fairly oil heavy, so oil is certainly playing a role in the trend here, but it's breaking out of a fairly clear 2-year bottom, right? That's significant. That all fits with the picture quite well. Growth boosts demand. Demand starts to outstrip supply. Prices increase. Inflation adds to price pressure because inflation is part of a late business cycle. And then you have investors and speculators rotating in, amplifying the situation. Okay, so I also mentioned currency competition, and this is really important because, of course, the metals that we all invest in, we largely talk about them and invest in them priced in US dollars. And for many years, the US dollar was the cleanest shirt in what was a really dirty laundry pile, right? So it was the obvious currency play. And that's why there was so many years when the US dollar was very strong. But that's no longer the case. Growth is now much more widespread. It is not just contained to North America. We have the European Central Bank and even the Bank of Japan starting to talk about tightening. Are they actually going to do it? That's another whole question. But the fact that they're talking about it is what matters. The dollar started to gain strength as soon as the Federal Reserve started talking about tightening. It's perception, right? Trump is a capitalist who wants a weaker dollar. He's been very clear about that. So the point is the US dollar is no longer the obvious long currency play. I'm not about to say that the US dollar is about to weaken a whole bunch, but it's got competition. And so that means that its upside is limited. It's probably going to stay within a range. It may be weaker than that. This is all really bullish. This helps the commodities story significantly. And then there's inflation. And if we're going to have any fuel that gets poured onto this commodities rally fire, it'll be inflation. Now, I'm not yet convinced that we're going to see a whole bunch of inflation this year, but I think this is the year that inflation is going to show up. When you talk to business managers, operators globally, especially in North America these days, the biggest struggle that they're all reporting is in finding and retaining good employees. That immediately because unemployment is so low, so that will lead to wage inflation. We haven't really seen wage inflation yet, but if they're struggling to retain good employees, what are they going to do? They're going to pay them more. That's fundamental. And so wage inflation is the canary in the, I say gold mine because I like gold mines better. So that's what I'm watching really closely to see if inflation starts manifesting this year. I think it will. And of course, inflation is really bullish for commodities prices. Oil is another important argument here. Now, the 2015 oil bottom below $30 seems sort of recent, but it was actually a long time ago, and Brent got above $70 last week, or earlier this week. Big difference. People are much more bullish on oil. The fundamentals look a lot better. And oil price increases are very important when we're talking about inflation. The IMF recently calculated that a 10% increase in the oil price adds 0.4% to domestic inflation. So that's a really significant influence. I don't know exactly what's going to happen with oil prices, but the fact that they're up this much, the fact that projections are bullish, again, it adds to the commodities argument. And then, of course, this is all about commodities offering relative value against a very expensive stock market, right? Now, a bull market is a bull market until it isn't a bull market. I'm not about to say that we're facing catastrophe in the stock market. I won't say that until it happens, because I'm apt to be wrong for quite some time yet. But there are definitely signs that we're late in the cycle. There's lots of signs that we're getting late in this equity cycle, right? We have a rate hike cycle underway. We have tightening underway. The yield curve is starting to flatten. Volatility doesn't exist. Confidence and greed measures are like through the roof and have been for a while. And valuations are certainly very high. So, against all of that, you have these inexpensive commodities. They're almost alone across the board in offering fundamental value. Investors and fund managers are really starting to notice that. And so that's the opportunity, that's the diversification that the commodities sector offers in this big picture. And what really matters for those of us who are interested in the metals space is that it really doesn't take very much. You need very little of the big pool of generalist investor capital to rotate into metals to make an immense difference, because the metal space is just very small. The oil space is bigger. It takes a lot more rotation to make a big difference in the oil space, but the metal space is very small. And so that's why it's so important that we're starting to see this in the mainstream media, that guys like Jeffrey Gundlach are talking about, and Goldman Sachs are talking about commodities being the opportunity this year. We only need a little bit of that money to rotate in, and I do think that that's going to be the story in the commodities space this year. As that story starts to manifest, leverage will return to this space. Leverage is what we've been missing. Leverage is why 2017 was so boring, right? If you're going to have a 12% gain in gold, that's great. But if miners are only going to give you 9%, then why are we even bothering, right? Leverage is what we all need. And let's take a step back and talk about just how lacking that leverage is right now. So for the 25 years from 1983 to 2008, if you took the ratio of the Philadelphia Gold and Silver Miners Index to the spot price of gold, that ratio averaged 0.25. Today it's at 0.06. Like, we're hardly even on the scale right now. And yes, there are some reasons why that ratio would have fundamentally declined over the past 30 years. Companies have issued more shares, mining has gotten more difficult, so you could argue that value has decreased if you want. And certainly miners have wasted a lot of money, so that has changed perception as well. But nevertheless, I think the conclusion, this chart was created by Sprott Global, and I think their conclusion really stands, which is that a 75% decline in the relative value of gold miners and the thing that they versus the thing that they produce suggests that we're going to get some reversion to the mean sometime soon, right? And so that will happen when leverage returns. Leverage requires more money to come into the space. That will come from generalist investors, and generalist investors are being encouraged by the opportunity that commodities offer right now. Okay. So that's my big picture thing. We want to zoom into today. The big question I think that we're all looking at today is gold going to do it, right? Gold's had a fantastic seasonal run so far. It's done very well. This chart, I think, or this table I created a week ago, so obviously the gold price is a little bit behind. So we're up 7.5% already this run, which is great. So the question is it going to get up? The big technical resistance is 1360, 1365. That's the line that everybody's watching. Is gold going to get above that now, like in the next 5 or 6 weeks, which is the seasonal run, or are we going to have to wait until the fall? Those are sort of the two options that I see on the table. I'm not sure. It's interesting to note that if gold were to achieve either its run of 2016 for the season or its run of 2017 for the season, then we would get well above 1360, or we would certainly get above 1360 and perhaps well above it. Interesting to note. Of course, past returns are no guarantee of future performance, so I'm not going to say that that's ensuring anything. But what matters is to watch it, right? Because that should influence at least some of what you do with your portfolio in the near term. I would say that if gold does get above 1360, 1365, whichever you think the number is, depends how you draw your lines, in the near term, that means that the market is on now. And so that suggests to me that there's less push for seasonal trading. So you don't need to worry so much about locking in seasonal gains. What matters is making sure that you have established the positions in the stocks that you love. And if anything, you can use a somewhat mild, there will still be a summer doldrums. There's always a summer doldrums, but it will be more mild. And you can use that summer doldrums to add to positions in stocks that you really love, or to enter into new stocks, quality stories, the select ones that come to light. However, if gold does not get above 1360 in this run, the summer doldrums will probably be more significant, in which case it makes more sense to be a bit more active in your trading in late February. Lock in a few more of the gains that you do get from this seasonal run and be ready to rotate that capital back in June or July when things are cheaper, before things really get underway a bit later in the season, okay? So that's my perspective on the current situation. Now, I'm bullish on commodities broadly. I think gold at 1360 is the question right now because it's kind of just the indicator of whether this momentum is really getting going today or whether it's going to take a little bit longer for this momentum to manifest, as in if it's not going to happen more until later in the year. So I'm talking about gold being the question now. I clearly am very bullish on a lot of metals, zinc, copper, silver, energy metals, coal even. I'm bullish on them all in the big picture. That's what I was talking about before. So just using gold as sort of the indicator in the moment. Those of you who've seen me speak before know that I often end with these two slides. The commodity space offers a lot of opportunity right now. I clearly am convinced of that. Hopefully you are as well. To profit from it is both easy and quite difficult. I think to get the best returns takes a lot of time. It takes a lot of networking into the sector. It takes a lot of research of macroeconomics. It takes following the news from a lot of stories very actively, and active buying and selling. It's difficult for everyone to have the time and focus to do that. That's what I do. And that's what I write about in my flagship publication, which is the Maven letter. Comes out once a week, tracks what I'm thinking, what I'm doing with my portfolio. I also have a premium service that allows investors to participate alongside me when I'm investing in private placements. Importantly, as with all the other newsletter writers who participate in this conference, we don't take money from companies for coverage, so we're objective in our decisions to buy and sell these stocks. And if you have any more questions or want any more information about my services, I have a handout at the desk, at the registration desk, and I'm here all day today and all day tomorrow and would be very happy to answer questions. That's my presentation for now. I'll be back up tomorrow with more to say, so hopefully you're not sick of me yet. But that's it for now for me.